Can you hear me right now? Am I? Hello, everyone. Welcome to the Sunday Market Update. Uh, Appreciate your patience. Looks like we're good to go now. Right now is an important time in the markets because, well, it's possible big down move. And I don't know that it's true, but if it were true, you'd want to know what you could do about it, right? So I hope to provide some insight on that. I think that uh, the currency markets are giving us a pretty clear signal, and the U.S. stock market. I'm going to start with the U.S. stock market and show you what I'm seeing there. Can you see my screen now? Anybody able to give me a little feedback there? Make sure you can see it. Thank you, Linda. Okay, others, yes, thank you too. So what we see here is just for the past year, we've had this long upward move. I've done some studies over the years and actually published this in um, the book I co-authored about 10 years ago, and made mention of the fact that if you have in the U.S. stock market a period of time where the market goes up, by more than 10%, right? If you look right here, there it is, date and price range. If you go 1 month, and if within 1 month you are up more than 10%, that's about it right here. If you have that phenomenon in the market, then for the next year, it's actually almost 13 months, you will have, you likely have a nice, strong, bullish market. I'm not always, but more often than not, something like, 70% chance historically. Um, but then you have, no, that's not the right line. Well, then what you come to is this period where from that point on, the market doesn't do as well as it did historically. All right. So let me style there. Just end that line right there. No, that didn't end it. Don't know why. Oh well, doesn't matter. So what comes next is a period of time which is dangerous. Like right after that period of time, then you get about an 8-week period, which should have been about right there. And this period of time is more likely to be bearish. All right, let's see. We've got somebody saying, Jeremy saying that it's the volume is low. Is that okay? I'm going to see if I can just move the mic up a little closer. How's that? Is that any better? Hello, hello. Is this any better, Jeremy? No? Oh, yes. Thank you. You're welcome. All right. Yeah, okay. Just had to get the mic closer to me. Now then, this period of time, uh, if you have a 10% move in a single month, you go about a year, and then from that point on, it's weakness. More likely for the market to be weak. Why is that? Well, there's a simple reason. If a bunch of people all buy into the US stock market, So much so that it moves prices fast, moves prices up fast. And see, 10% is very unusual. It's not, it's not that it doesn't happen, it's just that it doesn't happen very much. Maybe less than once every 18 months do you see that phenomenon happen. So, if in fact that does occur, then there are a lot of people in the market who believe that they want to hold on to it for at least 12 months, for at least a year. And the reason for that is that the US government charges less tax on your stock trades if you don't sell quickly. They call it long-term capital gains. If you buy it and then you hold it for a year, but then you sell it after a year and you take profit, assuming you have profit, if you take profit at that point, then you pay, well, half as much tax as you would. Instead of, if your tax rate is only 10%, well, 10% is you would pay no taxes at 10%. If your tax rate is 20%, then you'd pay 10. If your tax is 30%, you'd pay 15. You get the idea. It's just, it's a reduced tax rate. Now, to somebody who, doesn't pay a lot of taxes, that doesn't make any difference. But to someone else, like Bill Gates, and I use him as an example for an important reason, who's a billionaire and has a whole lot of money, when he paid half of taxes, it's millions and millions and millions of dollars saved. So to high net worth individuals and people who have a lot of money in the stock market, they care a lot about saving that kind of money. And so they like to hold stocks for at least a year. Now, if only one guy, Bill Gates, even if he has a lot of money, does that, it's not going to make that much difference in the market. But if, 1,000 high net worth individuals all make the same kind of a decision, then statistically it should show up on backtests. And in my research, I have found that it does. That if you have a month where the market rises 10% or more, and then you go forward in time and you track the month 13 to 15 months later, well, this period of time historically performs worse on average than all the other months in between. Here we can look back, hey, this was a bad month, that was a bad month, right? But I mean, if you look back historically for the past 100 years, you don't necessarily get a bad month right here or right there. It's all spread out. But this area right here, it does come down more. So it's a weaker period of time. So, about 3 months ago, I was telling people, hey, this is a danger zone. And now we look back at what's happened, and sure enough, I mean, look at what happened. Right in the middle of December, you get it started off, but then even at the beginning of the year, it's easy to see in this way. If you look at these candles, the size of the candles, how tall they are, right, through this period of time. See how you got tiny little candles all through here, tiny little candles, and then all of a sudden through here, the candles are much bigger. That is happening because there's more disagreement in the market about buying and selling. There's a lot of people who want to sell, but then there's a bunch of people that want to turn around and buy, and so the price, pops right back up. And that increased volatility is measurable by the average true range, which I'm going to add that to the chart. So if you look here at the average true range, well, we had this real big jump right through here. This was the period of time where Joe Biden stopped running for president and Kamala Harris jumped in and took his place in the Democrat Party as, the candidate for president. And so there was a lot of volatility there through that period. and then, it calmed down. But other than that, we haven't seen as much volatility since, anywhere in this period as we have since the beginning of the year. See how through here it's been higher than it has all through the rest of it, other than for that one spike. So that is the same kind of thing. We've had this period of volatility, big up candles, big down candles. This kind of volatility is often will often occur not only during this period of time, but during a period of time that signals the change from an up market to a down market. This here really hasn't been a down market. It's been more of a sideways market the past couple of months. But could this be a key indicator that, hey, it's time for the US market to stop going up and start going down for several months in a row? That would be a bear market, right? A bear market is something that usually lasts about 6 months and drops 20% or more from its highest point. Here, we would be talking about something that, let's turn the percentage on here. And if we were to drop down from our highest point right here to 20%, we would end up going to this level right here at a minimum, and maybe more, right? If we had a bear market, and it lasts, let's see, 6 months, we said, so that would go all the way to June, right there. So that's the kind of market that we could end up with, right? And let's have a look here. That would take the S&P 500 back under 5,000, or SPY under 500. I mean, that would be a huge downward move, and it would be kind of scary, right? Now, if this kind of thing were to get going, what would obviously you'd want to be shorting the S&P 500, like SPX USD. If your broker gives you the ability to trade that, you'd want to short that. But what else would happen currency-wise? Well, when you have a bear market, almost always the Fed will raise interest rates. Not right away, somewhere towards the end of the bear market, they will say, hey, let's lower the interest rate. Not always right at the end, sometimes early, sometimes in the middle, but one of the things, once the interest rate being lower starts kicking in, that's what turns the market around. So here in this case, they don't want to create inflation in the US. They don't want to raise the interest rates. They're probably going to wait a good long while, good 6 months, before they decide, okay, now we're going to need to lower the rates. So if in fact we were to get a bear market, that's kind of the trajectory that it would go up and down, but it would end up below SPX 5,000. And so in the currency markets, an interesting thing you see happen is that you would think that the US dollar would get weaker, that the less people would want it because the US economy is going bad, right? But that's not how it ends up working. That's when a bear market happens, when a bear market really gets going, weirdly, the US dollar tends to get stronger. Now, here's the reason for it. Follow me along with this, because it's almost like math. It happens so regularly. The reason for it is that it has, let me explain it this way. The reason the dollar is in demand has to do with the way people choose to protect their money. If you're buying stocks and you got a bunch of money, again, this usually has more impact for people that have, you know, multi-millions of dollars, right? If these people have their money in stocks and then they decide, because they see a bear market happening or coming or whatever, hey, I got to take that money out of stocks. Or if they've got it in the bond market, same thing, you know, I decide to pull it out. They don't put it into different stocks most of the time. They don't put it into other bonds. They just move their money to cash. And they aren't thinking about investing. In fact, they're thinking about the opposite. They're thinking like, I don't want to invest. I don't want to put my money at risk anymore. I want to make it safe. So they move their money to cash. But what is cash? It's the US dollar in the case of, you know, American investors, right? Now you could say, well, what about, you know, non-US investors? If they move their money to cash, shouldn't that, you know, be an impact on other currencies? Yeah, but most of the people involved here are US investors under these circumstances. They're they're the ones that are making this difference. And it isn't just individuals, it's hedge funds and pension funds and whatever. They'll move their money to cash until they figure out what to do next. So what that means is it creates a demand for cash, for the US dollar. So if people are moving their money out of stocks, they're moving their money into the US dollar. They're creating the demand for the US dollar. That's why the US dollar gets strong if the US stock market gets crazy weak. With almost any other stock market, with almost any other economy, it works the opposite way. If Japan were having a terrible economic downturn, the Japanese yen would get weak. But if the US is having a terrible economic downturn, the US dollar gets strong. That's the rule. I mean, that's how it's played out historically. If you go back and look at charts in 2008, you see this happened. And it's very counterintuitive, but that's exactly how it played out. Now, at first, you know, the U.S. dollar began to weaken, but then all of a sudden it got really strong, even though the you know rest of the economy was tanking, right? And even though they cut interest rates from 4% to 2%, and then you know eventually even you know below 1% along the way, that made the dollar weaker and weaker and weaker. You would think people wouldn't want the dollar, knowing that the Fed was going to cut U.S. interest rates, right? Well, that's just not how it happened. And it wasn't the first time either. You go clear back to 2002, and it went that way too. So in the case of 2022, just a couple of years ago, we did have a 25% drop right from the beginning of the year on. But that wasn't because the economy was going bad. It was because the U.S. Fed was raising interest rates. And the whole market was responding to that. You know, Fed hadn't raised interest rates strongly and specifically for decades. And so, you know, that changed things, changed the way the markets went. Well, what's happening right now? As we've gone through this last, you know, couple of months of danger zone, well, how have the currency markets been behaving? Here you can see the pound versus the US dollar. The US dollar has been getting weak, but just in the past couple of days, you know, shot up. How about the euro? Similar story, right? This one's the past 3 days. Australian dollar, it's been going up, but past couple of weeks, the US dollar got stronger against the Australian dollar. And here's the US dollar CAD, so it's the other way around. It's been going down the past couple of months, but just here in the past couple of weeks, strength. What's going on, right? I'm suggesting that it might be the case that it had been getting weaker because, you know, looks, you know, bad signs in the US economy. And then all of a sudden, now the demand for cash has gone up And we're seeing it here in the US dollar. Meanwhile, look at the Japanese yen. The US dollar Japanese yen is an interesting pair because it's like a global proxy placeholder for how much global investors want to risk, both US and non-US, want to risk in the investment markets in general. So the more people feel like, hey, let's do this, I want to try to make some money here, then the US dollar Japanese yen tends to go up. But in the past, since the beginning of the year, that trend has been very strongly down. Just had a little bit of curl up right here at the last, right? But that's been going down. And interestingly enough, you have the New Zealand dollar Japanese yen, it's been going down. The euro Japanese yen, down. Australian dollar Japanese yen, very much down, right? All of these are a demonstration of the yen getting stronger against these pairs. So the yen has been strengthening. How is that? The yen has more, there are more investors out there having demand for the yen. So they're demanding both the US dollar and the Japanese yen. Why is that? Well, we talked about why that could be for the US dollar if in fact the stock market's, starting to go bad and people are pulling their money out, holding it in US dollars and cash, right? But why would the yen be getting stronger than those others? And part of that is what's called the unwinding of the carry trade, or in this case, carry trades. Now, you might say, well, the carry trade is just the US dollar Japanese yen. If you know that phrase, then, well, over the years, it has not limited itself because the Japanese yen just keeps getting lower and lower and lower in interest rates. I mean, here in recent years, they've actually stopped doing negative interest rates, right? But the yen is like the most aggressive low interest rate currency. And so any other currency that pays interest compared to the yen, that pair, if you hold it overnight, would give you money, right? Well, the large banks, they love to collect that kind of interest, but it's speculative because if you collect 1%, but you lose 3% in the process, then you're minus 2% net, so that doesn't help you. So you have to speculate. If you're going to do this, you're going to hold and try and collect that interest rate, night after night or month after month or year after year, right? If you're going to do that, you have to do it during periods of time where the yen is not in demand compared to other currencies, because then those currencies will drift higher. You'll get the interest rates, and you won't lose money on the actual price of that currency pair. Well, if this period of time everybody's feeling nervous, right? They're going to pull back from doing risky things in the markets, and when they do that, they're going to pull their money back into yen because they sell the yen. See, they sell the yen down and buy some other currency. But if they pull their money out of that trade, what happens? The money comes out of those currencies and goes where? Into the yen, back of the yen. So it's the same effect that the U.S. U.S. investor has and the global investor has. When they pull their money out of their investments, they go back into the, or they aren't necessarily going straight back in, but they're releasing that money from being used against whatever currency. When I buy stocks, I'm long stocks and I'm short the dollar. I mean, you think about that. That's an investor, especially a U.S. investor, but a non-Forex investor, they don't think that way. They just, well, what are you talking about? I just bought stocks. Yeah, but what'd you buy it with? You bought it with dollars. So you're long stock, short the dollar. You unwind that, now you are short stocks and long the dollar, right? Well, global investor then, you're long whatever currency and short the US or the Japanese yen, and then when you get out of it, you flip. So the yen is now in demand. The big question is, under these circumstances, which currency will be in demand more, the US dollar or the Japanese yen, right? Um, Here, just in the past 3 days, just like here on the euro, we saw the pound get weak compared to the US dollar. We've also seen this little hook right here. So it's possible. I have been expecting that the US dollar would stay weak and get weaker compared to the yen. So this pair would be good to short. Short US dollar yen. And that's been good for the past 2 months. But if in fact you get into a big bear market in the US, that could turn around and you could see the US dollar Japanese yen pair go higher on the strength of demand for US dollars. So that's your big opportunity right there, is the dollar yen. If in fact you see the US market start to tank like this, then take a close look at the US dollar yen pair, because it might be a big opportunity to go long that way, right? Wouldn't that be interesting? Well, it would if you could make the trade and profit from it. But, uh, it's always with trades, it's better to assume you do not know the future. You just set up your trade and make a good trade. You have a trading plan. If I want to risk one to make one, if I want to risk one to make two, right? I set up my plan and I stick with it. That's the best thing to do over time. Over many trades, you follow that pattern, then you tend to do better. If in fact you try to guess and say, "Well, I know what's going to happen," well, then the problem is that if it doesn't do that, it goes against you, and you keep holding it, and you just you make your loss go worse and worse and worse and worse, right? So how can I say to myself, well, US dollar, Japanese yen, um, well, a couple of things I wanted to show you. Since the beginning of the year, 2025, there we go. I can zoom in here and move this along. This colored spaghetti chart is a relative strength of various stocks in the U.S. market. Okay, now this is a key little bit of data. You might look at this and say, "This means nothing to me, Gordon. I can't make heads or tails of this." Yeah, but let me give you the key. What I want to see is if the technology stocks, the growth stocks, and so forth are doing well, or if the defensive kind of stocks are doing better. I should probably add one more to this list if I can. Oh, good. There's room for it. All right. If I highlight this one right here, oops. Yeah, I don't know if you can see it or not, but it is this line right there. That sort of red line. Maybe I'll make a change to that line so that we can see it better. Let's make it this color blue, that bright blue, and we'll make it very fat. There you can see it. Okay. This is a utility company. When markets are going bearish, utility companies tend to go up, tend to go higher. Over the past 2 months, the black line is the market in general. It's kind of going up, kind of going down, but trending lately, starting to trend down. And notice that the blue line is starting to trend up. I mean, it's for the past 2 months kind of been going up, had this big drop, but that's reversed, and now it's going up, right? Let's look at the stuff that's on top, though. What's up there? That's GE. That one is Intel. Intel's been a terrible stock all year, and all of a sudden it's jumping up, right? Well, this is the demand for semiconductors. This one here, what looks to be one of the top 5 is Micron. That's a semiconductor stock. And how about that one? That is Facebook, which has been on a big run. And that one's Citibank or Citigroup, a banking stock. So basically what you have is finance and technology stocks that are leading the charge. When those kinds of stocks, finance, technology, particularly technology, and also consumer discretionary, when they're heading higher, then the market tends to keep going higher. But if in fact they're going lower, and you see stuff like the utility stock or this stock here, Verizon, oops, where's Verizon? Yeah, Verizon is right there next to Duke Power, the utility stock. When you see those ones start to go up, that usually signals a time that the market is about to go down. Here's why. The people who move their money or who recognize, hey, I'm worried, I think the market's going to go down. Individuals, they'll move their money to cash. But professional investors, institutional investors, they are required to keep the money in the markets. If I own a stock mutual fund, I put my money in stocks, and I put my money in the mutual fund, then I expect the mutual fund manager to keep my money in stocks. I don't expect them to put it in cash. I can do that. But if I leave it in the mutual fund, then I want that money in stocks. Or at least that's the theory, and that's the rule that got made by the US government clear back in 1934. So mutual fund managers, they don't pull their money out. They're smart guys. They pay attention to the market. They know, hey, the market could be going down. So if they have to put their money somewhere, where do they put it when they know the stock market is going down? The answer is they put it in a stock that's not going to go down very much. They put it into a utility stock which pays dividends. And Verizon is a phone company stock that pays dividends. Duke Power is a electricity company that pays dividends. So if those stocks are going up while the rest of the market is going down, it's a big signal that the big guys, the institutional players, they are concerned and they're moving their money to safety. And when you see that, it's yet another indication, hey, we could be headed for a downward market, and we better watch out. Also, when that really starts to happen, usually the stuff you see that's going down are the technology stocks. Well, that's Tesla. The worst of all these stocks on my list is Tesla, and that one is AMD, also a technology company, chip company. There's General Motors, car company, and that is a manufacturing company. And then there's Google, technology company, if there ever was one. And then there's this stock here, which is Ford, another car manufacturer. And that one is NVIDIA right there. So the bottom 5 are all technology companies. Tesla and NVIDIA, those are kind of the two quintessential technology companies, right? We still have some technology companies up here in this list, but that's partly because I'm working off this bigger list over here, which is growth companies, and most of them are technology companies. So if we take a little bit of a closer look and think, right here, what's going on there? GE, that's not a technology company. That's a manufacturing company and a defense contractor. They make money in wartime, right? And they're the top out of all these right now. So it could be that the world, all investors in every nation are a little bit afraid of these talks that are going on with Ukraine and the U.S. President Donald Trump. Zelensky and Trump had this big blowout argument on Friday. The day before, NVIDIA released earnings, which were all good, but all the investors said, no, we don't believe you. We think that things are going to go bad for you. NVIDIA came out and said, hey, things went well, and we believe they're going to go even better. And the market says, we're calling your bluff. No, you're not. Right? And so that's interesting all by itself. Whenever you get good news in the market and investors sell it anyway, that means everybody's in kind of a risky, or I don't want to be risky, sour mood for investing purposes. They're like, let's stay away from the market, right? When you have that kind of a thing, then that means that it is a world where investors don't want to take the risk, and asset prices are more likely to go down than up. Okay, that's the whole scenario. So just by looking at the stocks, which stocks are going up and down, we've got clues that confirm yet again people are pulling back. They're being nervous. They're worried. When they're worried, they tend to not buy stocks, but they tend to instead put their money into cash. One more chart that I'm going to show you here, and that is the VIX, the volatility index. Okay, the VIX is sort of, well, what the VIX is it tracks the average price of the most heavily traded options in the US market, options on the S&P 500 specifically. And they mainly, it mainly looks at, is that, yeah, I got it right. I just got to move this down a little so we can see this. It mainly looks at the SPX options that are at the money. If you know option trading, that's the options whose strike prices are close to the actual price. And that's the most heavily traded option contracts. And so, it's really, the VIX is really trying to get an idea of how much money are we charging for options nowadays, right? Now, if you think of options as insurance, particularly put options, right? If you think of them as the price of insurance against falling prices, then you can look at this chart and say, what's the price of insurance against falling prices? Knowing that what that means is if the price of falling price insurance is going up, more and more people are expecting that the prices are going to fall. If you bought insurance on fire insurance on your house because you think, hey, my house could burn down, right? If there's no fires anywhere, that the price of that fire insurance is not going to go up. But if all of a sudden people start thinking, hey, there was a fire, 100 miles away from me, just a little bit, but it burned for a while and it scared me. There was another one over there and another one over there. There's more fires. I think it's fire danger season. I think I'm going to go make sure I have enough fire insurance. I'm going to buy more if necessary, right? Then that means more demand for insurance, and the prices, the premiums of that insurance go higher, right? If there's fire right down the road, I'm on the phone. Hey, do I have insurance? In real time, the market investors are buying put options, minute by minute, day by day, hour by hour. So we can track the price of options. And if the price of options are going up, it's because people think the market is about to go down. They're seeing the fires of falling prices burning, and they're running to try to get some insurance. So some people call the VIX the fear index, right? It's just a measure of how fearful people are. And the more market prices go down, the more the S&P goes down, the more these prices go up. And they keep going up and up and up and up and up until all of a sudden when they stop going up, that's usually about the end of the bearish market. Back in July, when Joe Biden stopped being president, or stopped running to become the next president, or the next elected president, then market prices dropped 10% in a week, right? And look what happened to the VIX during that period of time. It shot way up to, above 30. Since then, it's come back down. I have found that any time you have a drop in price of 30% from whatever the highest point of the VIX was, like in this case, it was way up to 65 intraday. It closed right here, 38. So if in fact I go from 38 to, the next week or so, does the price of the VIX drop by more than 30%? If it does, the chance that that's kind of a market bottom going forward is very high. So if I see, in this case here, we went from 38, I mean 30% of 38, right? So 10, 12 points. All it has to do is drop from 38 to 26. If we go from 38 to 26 in a week or so, that's probably the bottom right there. And 1, 2, 3, 4, 5, we ended up at 20. So yeah, this huge spike, then it comes right back down. But the same is true also for this kind of a situation where you have, 27. Well, if that drops 9 points in a week, 1, 2, 3, 4, 5, 27 to 14, yeah, that dropped more than 9 points. Then that's kind of a minor bottom for that point in time. And in 26th of December, it was. I mean, it hasn't been that long, and the market didn't go up that much, but it kind of held as a bottom. So here now, what have we seen the VIX do? From that point, the VIX has been creeping higher. And just in the past week, we're looking at the VIX really moving up. And now let's look right here at these last 2 days. This is an important comparison. All right. Look at the size of this candle on Thursday, the day that everybody decided to call NVIDIA's bluff. We go from 18 to 21. Big move up. The next day, we go from a little bit higher than 21, well, we're at close, 21.12 to 21.19. And, it shot up and then came all the way back down. And it closed at 1964. Not quite halfway, maybe about halfway of this big candle. It landed near the middle of that big green candle. All right. Now we're going to look at the S&P 500 chart, and we're going to flip this upside down. If in fact this were doing the exact same thing as the market, then what we'd expect to see is for the market to have a big down day, opposite of the VIX, right? And for it to come back up to about the middle part of that down day. All right, let's see what happened. Well, actually, how about I do this and we compare them side by side? I'm going to turn this one into SPY. Oops. Oh, I'm hitting the wrong key there, sorry. Okay, guys, okay, there it is. All right, look at this. See, now this, we can see this even more clearly if I turn the VIX upside down by simply going 1 minus VIX. That's going to flip the whole chart upside down. See that? Now we want to see these two look exactly the same. All right? Red, 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 red. But notice, do you see the difference? Do you see the important difference? What we're seeing here is that the US market didn't just stop halfway through. It went way up. Okay? But the VIX did not go way up. It didn't go 3/4 up the candle like the US market did. It only went halfway up the candle. What's going on? Why is this not going all the way up? right? Well, remember, this is the price of insurance. I've got it upside down. I'm going to turn it back right side up here, and then my explanation will make a little more sense. Upside down, it'll be confusing. Okay, this is the price of insurance. This is the price of insurance against falling prices. This tells us how much people think the prices are going to go down. The higher this gets, the more people think prices are going to go down. So if the price of falling price insurance, is going up and up and up, that makes sense if prices are going down and down and down. The fires keep getting closer and closer, so the insurance gets more and more expensive, right? You can think of it that way. Now then, if all of a sudden the prices come back up, shouldn't prices go down? Well, they did, but they didn't go down as much. They should have come down to here. And it's not a huge difference. It's 1960 compared to 1890 or so, right? But why didn't it come all the way down? The answer is there are still too many people buying put options. If you buy put options, it makes the VIX go up. That's I mean, the full explanation is a little bit more technical, but generally speaking, if more and more people buy put options, the price of the VIX goes higher. And here, this was an upward move, but did everybody give up their put options as the price came back up for one day? No. There were still a lot of people that held on to, and others that still wanted to buy new put options from this point. So what are we seeing? We're seeing in the kinds of stocks and the way they're performing, we're seeing money moving towards utilities. In the U.S. market over the past year, we're seeing the sort of sideways move where it had been a long upward move. In the currencies, we're seeing demand for the U.S. dollar. And now here in the VIX, we are seeing that people are buying put options. All of these indications are showing us, all of them are showing us that, hey, people are worried, investors are worried that the U.S. market is going to go down into a long downward move. That bear market, the big blue line I drew, they're worried that is going to happen. It's not everybody, but it's enough that it's showing up in all of these places. I have one more indicator that tends to be right about 90% of the time. One more indicator I watch for these kinds of signals. And let's see if I come to here, I open this up, and I change my chart pattern to my stop-go method. Here, this is what we're looking for. If in fact I see the average true range climbing over the past 2 months, so far, and this is just one day, February, right? March, one day of March. It's, the average true range is not going higher. But over the 2 months, January and February, on average, it is. And if in fact we see through March that start to continue, then then we're going to see this thing go up, and then we'll know, hey, that's 2 months in a row, or that's a trend over the past 2 months of prices going higher. If I see the market increase its average true range, and if I see the utility stocks going up more than the S&P 500, then if I see that for 2 months in a row, then I know it's 90% chance we're going to have a bear market coming after that. We do have the utility stocks going up while the S&P is going down, just in the past month. 2 months ago, January timeframe, December. In December, utility stocks were not going up as much. So we've got the first month here. During this period of time, we need to see for 2 months in a row, the S&P going down, utilities going up, and the average true range also trending higher. So we got the whole month of March for this indicator to become accurate. If in fact we see the average true range increase over the month of March, utility prices increase over the months of March, and the S&P 500 prices either go flat or down during the month of March, that will complete this indicator. So we've got a whole month to watch. If in fact that happens, 90% chance that the market will keep going down more through the month of March. So that's the final indicator I'm watching for to be able to know whether or not I need to move all my money to cash. And I'm not going to wait until the end of March. If by the middle of March I can see that, hey, the VIX is still high and getting higher, and the prices are becoming more volatile and taking out old lows, then I'll know, hey, that's it. So by March 15th, I fully expect to be able to make a decision that it's a bear market and I've got to treat my investments that way. Following this methodology, back in 2007, I got all my money to cash, and that worked for me for the year 2008. I didn't sit in cash the whole year, but what I did do is carefully trade. I didn't just buy and hold, but I carefully traded gold throughout the year 2008. Most of my friends were down 50%. I was actually up 9% in the year 2008. And 9% is not a lot, but in a year where everybody's going down and the only thing I'm doing is trading gold a little bit here and there, that was pretty good performance, right? This year, if I knew it's coming, I don't have to just be careful and trade gold. I could get a little more aggressive and play the downside. But the whole idea of a big bear market is you don't have to, as a longer term investor, you don't have to beat the market with a huge gain. You just have to not lose money. It's just to hang on to your money, right? So if you put it in cash and maybe you buy a little gold and you hold on to that, then you're going to do better than the rest of the market, right? Or if you buy utility stocks. I mean, utility stocks will go down. They just won't go down as much, but they'll also pay dividends. So you tend to keep your money during that period of time. And as if a stock market investor, that's the way you're thinking, you're doing all right. In the currencies, you got to pay attention to what are the dollar and the Japanese yen doing. Over the next 2 weeks, if in fact we get into a big bearish market, then the currency markets will give a clue on how this is going to play out. Watch the U.S. dollar, Japanese yen closely. If you see the U.S. market going down for the next 2 weeks, or generally over the next 2 weeks, and the U.S. Japanese yen pair going up, then you know that's the trend that will continue if the U.S. follows a 6-month bear market, right? So now you know what to watch for and what to do about it. If in fact the U.S. dollar, Japanese yen, or if the U.S. Stock market starts going down and has this longer term run, you know how it will affect the currencies and what to do about it. Look for U.S. dollar strength, and that's not just going to be U.S. dollar yen only, but anything. Euro U.S. dollar, what's going to happen? Euro's going to go down. That's what that is. Australian dollar is probably going to get weaker compared to the U.S. dollar if the U.S. has a bear market. Before I end this, I'll just ask if there are any questions. I've covered a whole lot of ground, and I've taken more time than perhaps is usual through here. But I just want to make sure that if I said anything that's a little confusing, let me know here, and I'll try and clear it up. But I do want to mention that if you're watching the VIX, VIX is the ticker symbol, then what you want to pay attention to is it trending higher, right? or lower. And you can do that just with the simple moving average. And that's a 9-period moving average. Usually it's pretty good to use like a 20 period. Yeah, so Kenneth, hey Kenneth, is asking why when the, if in fact the US market's going to go down, why in the, if you, when the US stock market is going down, why is the dollar going up? And the answer is because people are moving their money out of stocks and into cash. So they're showing a demand for the US dollar. They're not thinking of it that way. They're not thinking, oh, I want to buy US dollars. They're just thinking, I don't want to own stocks. So they put their money into US dollar cash to let it sit until they figure out what else they're going to do. So that's what's behind it. Money coming out of the stock market, it goes to cash. That creates a demand for US dollar. That makes sense? I hope that explanation worked for you. But it doesn't matter if I do it or you do it or one or two or three people do it. What really matters is if institutional players, guys who run mutual funds or high net worth individuals, if they do it, then yeah, not going to go to the carry trade such as the US dollar yen. No. In fact, it's the opposite. Money that is in the carry trade is worried about the risk of US or of investing markets in general. So it comes out of the carry trade. And that's why it, instead of the, sorry. That seems to go counterintuitive, and that's probably what you're asking. If in fact people pull money away from the carry trade, then they want to stop selling the yen and stop buying the dollar. Shouldn't that make the US dollar go up, right? Yeah, that's a very good point. And the weird situation is this thing where the exception is if in fact you have a US bear market, people might want to go into the dollar anyway, but they wouldn't necessarily want to go into the dollar yen. They wouldn't. They'd be buying the U.S. dollar, but they wouldn't necessarily be selling the yen, right? They're just pulling their money out of the U.S. dollar and putting it in U.S. dollar denominated accounts. And so that means that has the impact typically of making the US dollar go strong against the yen and the US dollar strong against the euro. But if in fact people want to not buy the yen as much, well, then it doesn't make the US yen go weak. It kind of makes that thing go flat, is what it does, right? So I actually think that U.S. dollar yen, Japanese yen, is more likely to continue going down, but right now it's not. The past couple of days, it's shot up. So you got to pay close attention to what it's going to do the next 2 weeks. Well, now, okay, that's really kind of a good thing. I should talk about the other side of it, but generally speaking, the US dollar goes up because people demand cash and they pull away from the carry trade as well. However, if they pull away from the yen more than they pull away from the dollar, then the US dollar yen pair could still go up. That would be the exception to all the other pairs. All right, there. Hopefully I've answered your question, Kenneth. I don't really know whether the US yen pair is going to go strong or it's going to go weak. But I'm going to watch closely over the next 2 weeks if the US market goes down. Now, here's another question. What if the US market does not go down? What if it doesn't go into a bear market? Because it could do that, right? This whole little move on the U.S. Market on Friday had a lot to do with um, Donald Trump telling Zelensky, "No, we're gonna stop paying for your war." And Zelensky's like, "We're getting attacked. You have to help us. You have to help us have peace." But what he means is you have to help us go take back all of the country that was lost to Russian aggression, right? And Donald Trump is saying it was never our war to begin with. My predecessor was giving you billions and billions and billions of dollars. I don't want to do that anymore because the people elected me to stop wasting their money, and so I'm not going to help you uh, by spending more money. I am going to help you by negotiating a peace treaty so that we stop the war. And Zelensky's like, I don't want to stop the war now. Then I'll lose half my country, right? But underneath the words they're saying in public are, you have to give me money. No, I don't. That's the real argument, right? The investors care a little less about that argument than they do about the idea that the US and Russia don't go to war because they don't want to see a nuclear war because that could destroy all of society. That's the bigger thinking. So if we go to peace now and stop fighting, even though half of Ukraine that has been taken by Russia stays with Russia, right? That's good as far as the market's concerned, because at least then there won't be the threat of nuclear war. But if the US comes along and says, oh, okay, Mr. Zelensky, yeah, let's jump in the war with you, then Russia is going to get its finger over the nuclear button, right? And if that happens, well, that would be bad for business, with the exception of defense contractors. So this, running back up happens at the same time that Donald Trump says, no, we're not going to fight a war. Then what you could see the market is saying is, oh, that's good. I'm glad because I don't want the US and Russia to be at war. That's how we can read that chart. Is just that difference from one day to the next. And so if in fact this has all been a fear of the US going to war and other things, this is at least the fear that the US is not going to war, or the hope that the US is not going to war happening, that it's running up. So let's suppose that that sentiment prevails and people are like, oh, good, World War III is not going to happen. Then we're probably going to see prices come all the way back up and make a new high over the next 2 weeks. That's not going to be a bear market, right? We're also going to watch to see, does the VIX come down 30% from its high? Its current high as of yesterday was 2240, right? 2240 minus 30%, that's going to be about 7.5 points. So if in fact we see this thing drop to about 15, it's got to come clear down into the 15s from this point. If we see that within the week drop down to 15, bear market's off, right? That's it. So that's how we'll know there's not going to be a bear market. That was the last little bit I wanted to get you. I'm told my time is up, so away we go. Everyone, appreciate your time and glad that you were here.